American equity markets are kind of on the rebound here. We've seen following this Friday drastic sell-off that U.S. Retail sales, obviously this data coming in showing an increase of 0.7% for the month of March, all kind of providing the latest indication that consumption remains strong despite inflationary pressures. And while this weekend certainly presented some troubling geopolitical headlines, our next guest says in times like this, it is very important for investors to have a plan, to stick to the plan, and ultimately rebalance. So joining me this morning to share his latest market thesis, including the macro themes moving markets this week, is Fidelity Director of Global Macro, Jurrien Timmer. Hi, Jurrien. Great to see you. How are you? Happy Monday.
Good morning from Boston Marathon Monday here. When I walked over this morning, all the roads are blocked already, and there were fighter jets flying over, and it's a big day in Boston.
A big day in Boston. So yeah, it absolutely. Well, we wish all participating the best of luck on hopefully a sunny day there. Tell us a little bit about what needs to be some sage advice ultimately for those watching headlines nervously from abroad and what it means for portfolios.
Yeah, these are always very troubling, obviously, things to read about and hear about. Nobody likes war, and the Middle East, of course, is a very long and sad story on that front. And whenever stuff like this happens, I always get asked, what should investors do? And I was actually on TV twice on Friday, and that question was asked. And I always have to explain that I don't mean to sound cold-hearted, but as investors we have to make unemotional, disciplined decisions based on the fundamentals. And the question, of course, whenever there's geopolitics happening, is whether it is systemically important for. Obviously, it's systemically important to the world and humanity, but is it systemically important to our markets, right? So if we're in North America investing in equities and bonds and other assets, how does this impact the fundamentals of those markets? And of course, there is a link there, right? If oil prices spike or if supply chains get further disrupted in the Suez canal, obviously that is systemic, but it's always a challenge to think just in a really kind of detached way about, okay, like if we made emotional decisions about our investment portfolios, we would probably be in cash most of the time, especially if we're always responding to scary headlines. And compounding does not work from the sidelines, right? So that would be the overall message. And so then the question comes back to, okay, are you comfortable in your portfolio? Do you have a solid investment plan where you are maximizing returns per units of risk, right? Where the comfort level is between the returns that you're trying to solve for while being able to sleep at night, basically. And from there, it's a question of just detached, disciplined focus on that process, on the journey, and maybe less worrying about solving for the outcome, although that's always tempting to do. And then to use periods of volatility, and we really haven't even had that yet, but to use periods of volatility to rebalance, right? Because if you have big moves, like we should rebalance on a regular basis anyway, right? Our birthday or, whatever, certain times of year. But when you have volatility events, that's also a good time to rebalance because it'll move things around. And that's a good opportunity to make sure that we're still in the place that we want to be. And then beyond that, it's just a question of, okay, given all of that, how do these events alter or affect kind of our investment thesis, right? And we all have investment thesis. I have one. And it turns out in this case, actually, I think what's happening in the Middle East is only solidifying or strengthening the thesis that I've already had, which is one of fiscal dominance, taking over from monetary dominance, sticky inflation, economic resilience, this weird backdrop where gold and the dollar can rally at the same time. So things like that, things that we've discussed, in recent weeks, and also that interplay between stocks and bonds. You know, like the 10-year yield today is at 4.63%. It was at 4.5 something on Friday, and it's been rising in recent days, even with these geopolitical headlines. That is not the way things normally work, and there's a signal in there that we need to pay attention to.
Okay, so the signal in there is that it is not systemically important.
The signal, so
Market.
far in the Middle East, and obviously we don't know what's going to happen.
Yeah.
It will depend on whether Israel, exercises restraint and or whether it retaliates, and then whether that whole thing escalates. So, if oil prices go well above 100, that's been enough to cause recessions in the past, not always. But my point is that at this point, things seem, okay, and that the things that markets are doing or not doing, I think that there's what we call a tell in there. And so the stock market obviously is not cratering right now, although it had a very bad day on Friday. The S&P 500, actually, I forgot that we have slides. Let's pull up slide 7. On Friday, the market did obviously fall, and the equal weighted index, which I have been watching closely over the past so many months, fell more than the cap weighted. So the market's down about 2.4% from the high, and the equal weighted index is about 3.8% from the high. So we're kind of in very modest correction mode. I mean, not really even. I would say correction is 10% or so or more. But that comes after a 28% run from last October's kind of wobble. And that 28% was in a straight line, right? So the market, is down a few percent after a really, really strong advance. And so, it's too early to conclude whether the uptrend is over. I don't think it is. I think the market is still in good shape. But this thing that I've really been focused on lately is the interplay between bonds and stocks, and the fact that yields are not falling at a time of geopolitical uncertainty tells you that there are stronger forces at play. And that brings us to kind of the stocks to bond correlation. And it has been really since 2022, it's been the opposite of what probably everyone in this audience right now, myself included, is used to, right? We all grew up in the 60-40 paradigm, where when you have a shock to the stock market, to the economy, which creates the shock to the stock market, yields will fall, and the 40 in the 60-40 kind of, they won't necessarily save you, because 40 is less than 60 and the 40 moves less rapidly than the 60, but it provides a counterbalance. But it hasn't always been that way. If we can pull up slide 15 here, before the 2000s, I would say from the mid 60s until the late 90s, so a very long stretch of time, the correlation was positive between stocks and bonds. Actually, let's pull up slide 17 first, and then I'll move to this one. I got lots of colors. So the top panel here shows the rate of change for equities and for bonds. And bonds I'm measuring as the total return here. And then in the bottom, I'm showing the correlation, the 5-year correlation. So from the 60s to the late 90s, bonds were positively correlated to stocks. And you can see the two little squiggly lines in the top tended to move in the same direction. Now, since around late 90s, 2000, when kind of deflation replaced inflation as the dominant worry, if you will, or the dominant driver of policy, the two lines have been the opposite. And since 2022, when the great rate reset happened, we're back to a positive correlation. So this is of existential importance to all of us investing portfolios, whether it's for ourselves or for our clients, because how that 40 interplays against the 60 really will drive, what is even considered a diversified portfolio anymore. And so in the old days, and now we can go to slide 15, when we would look at the valuation in bonds and the valuation in stocks, so stocks, you look at a PE, in bonds, you invert the yield, you get a sort of a PE for bonds. They moved in lockstep. So look at that red part, which the red part shows when the correlation is positive. The the two lines moved in lockstep. And what would happen is yields would go up because you would be in a late cycle economy, inflation would accelerate, the Fed would slam on the brakes, all the things that we are, typically, familiar with. It would be that rise in yields that ultimately would kind of start breaking the stock market. We talked last week about, crying uncle, whether that was a Canadian expression. Well,
Yeah, no, I think we know it. Yeah.
yeah. So yields would rise until the stock market would cry uncle. And 1987 was the kind of the poster child episode in that, because the Fed was raising rates, the stock market was completely ignoring it, and then they raised, some more, and then the stock market cracked. So the reason I mentioned this is that if we look at what happened last week, yields rose, stock market starts to wobble, and of course that's
there's a question about why yields rose. Just you sort of mentioned it before, but maybe you'll come back to that.
Absolutely, I'll get into that in a moment. But yields rose, stock market started to wobble, and then of course then the geopolitics happened after that. But last October, when the stock market really wobbled, right, it was kind of like peering into the abyss of higher forever rates. The stock market wobbled as well, and of course in 2022, when the Fed significantly raised the cost of capital, and other central banks as well, the market had more than a wobble. It had a very large decline. But that is the opposite of what we're used to, right? And what we're used to is there's a shock, stock market goes down, but bond yields fall, and therefore make up to some degree what's happening. So the question is, why are yields rising? Let me show slide 16. As you can tell, I've been playing a lot with colors in my charts. I like color. So this chart, I actually really like this chart. The shadings show the volatility of inflation, which can go in either direction, right? So the red means that volatility of inflation is rising. And that can be because you have deflation, right? The inflation rate is falling rapidly, or it's when you have inflation, meaning it's rising rapidly. And so the great moderation, that period, in the 2000s and 2010s, was generally considered a period of low inflation, low volatility, with the exception of the financial crisis, which is that deflation part there in the chart. And the reason why it's exactly 5 years long is because these are 5-year correlations. So when that shock happens, it takes 5 years for those data points to go out of the sample. But so the financial crisis aside, we are in a period of obviously higher inflation and rising volatility of inflation. And that has a lot to do with previous periods, 60s and 70s. And those were periods of fiscal dominance. Obviously, we've had the supply chain stuff from COVID, but this country and other countries as well are running very large deficits. And there is, I think, very little chance that is going to change anytime soon, right? Because of the entitlement spendings, defense spending, debt service in general. And so that brings into light, let's go to slide 14, what we call the term premium, right? The term premium is the risk premium in bonds, in long bonds. Short-term bonds don't need a risk premium because there's not really a long window of either credit risk or inflation risk. But the term premium is like the equity risk premium, but for bonds. And so when you have periods of fiscal dominance where deficits are very large and very persistent, debt levels are very high, inflation is sticky, which is clearly is right now, and the Fed's role, or the central bank's role, is not quite as dominant as the fiscal side's role. I mean, obviously the Fed is important, and the Fed has a very restrictive policy, but even with that restrictive policy, the money supply is growing, and I think that's because of the fiscal side. So to get to the punchline of the question you asked about what's moving yields higher, to me, the answer is well, it's never simple, but if you look at the orange bars in this chart, that's the term premium. The term premium is basically zero-ish right now. Historically, and I don't have a long-term chart with me, but historically, the term premium tends to be positive, as it should be, right? A risk premium should always be positive, because if you're lending money to a government for 30 years or 10 years, you want to have some premium there in case, they don't run their fiscal house very well, or if there's inflation, or, for corporate bonds, it would be credit. And so normally there is a positive risk premium, but over the past decade or so, the risk premium, as you can see in this chart, has been negative. And I attribute that to the heavy hand of central banks, not just the US, but others, Canada, England, ECB, Japan, using zero interest rate policy, or in some cases, negative interest rate policy, and of course, large balance sheet operations to suppress bond yields. And so that's why the term premium, in my view, has been negative for the past decade or so. But in an era of fiscal dominance, and where the Fed is no longer doing zero interest rate policy and no longer being the buyer of first or last resort of the Treasury's ever expanding debt load, why shouldn't the term premium be positive? And I think it should be. I think, it's easy to see the 10-year yield go to 5% again as the term premium returns. So in my view, this is the dynamic that's playing in the bond market. And that is, it's not ruining the story in the stock market, because, a year ago when rates were rising, there were no earnings, right? Earnings growth was falling. And per the valuation, model of the DCF model, you're calculating the present value of future cash flows or future earnings. When you do that and the cost of capital goes up, but earnings are not counteracting that by growing, then obviously you have a large negative impact when rates are rising. Currently, earnings are growing at about 10% a year again. So earnings are doing more of the heavy lifting. And this, by the way, is why the market is a lot less sort of perturbed by the Fed's ongoing unpivot, right? But so to me, that's the interplay. And again, it doesn't mean we shouldn't own bonds. I mean, bonds are paying a positive real return. There's a place for them in a portfolio, but they're no longer negatively correlated. You are getting paid to own them because real rates are positive, but it's a different landscape than what we're used to.
So this is a royal we, are countries that are deeply indebted, our own country in Canada, the US, lots of other countries you just mentioned, are we inflating our way out of debt? I mean, we're just continuing to issue the debt. So I mean, it's sort of an ongoing problem, but what is the argument there?
Well, so we're not inflating our way out of debt, at least not yet, because the Fed and other central banks have, been more hawkish. And in my view, the Fed is consciously kind of leaning against the fiscal dominance by keeping rates maybe higher than otherwise would, because the Fed made a pretty fatal policy error back in the late 60s by not appreciating the inflation threat and being overly focused on kind of the full employment side of the equation and less so about the inflation side. And so, but this is just a hunch. I mean, it's not like Jay Powell told me this, over dinner or something. It's just my hunch. But my sense is that the Fed realizes the impulse, the liquidity impulse that's coming from the fiscal side, and therefore is keeping higher restraint. And the Fed, I think, rightly understands that it's much better just to not pivot now than to over pivot and then have to unpivot later, right? Which is what happened in 1966 and 67. It pivoted and it should not have done that. And then it had to just take back those rate cuts and then some, because inflation was accelerating. So yes, inflation, of course, is being sticky. 3 or 4% is the new 2. That's I think that's a safe assumption in my view. But real rates are positive. So in that sense, we're not really inflating. I mean, we are inflating out of debt in terms of, if you measure debt to GDP, nominal GDP, then there's an inflation component to nominal, right? It's real growth plus inflation is nominal GDP. So the debt stock is rising, but nominal GDP is rising, because real growth is positive, but also because inflation is well above 2%. So in that sense, yes, the answer is we are inflating our way out of debt, but it's not quite as deliberate as, for instance, in Japan, where the Bank of Japan has been directly monetizing debt and therefore keeping the cost of interest rates very low. Like the Fed did that in the 1940s. It kind of did it after COVID, but it's not doing it anymore. If we went to if we stayed in a high inflation regime, and on top of that, the Fed started monetizing the debt, that would be a whole other, kettle of fish. But we're not quite there.
There's some great questions coming in on things that I think you've been connecting here. So one of them certainly is on gold. If we can just kind of bring that in. So how do you see gold reacting to the latest geopolitical news? And in fact, gold's been reacting for a while. So could you fold that in for us?
Yeah. So let's go to slide 21. So this has been really fascinating to watch, right? Because, and again, to me, it's another tell that a regime shift is underway from the old days where monetary policy was the dominant driver of everything, basically, certainly of asset class returns. And so, I've studied gold for a very, very long time. Many others have well. And one of the things we know is that historically, gold is different things at different times. It kind of changes its stripes. Sometimes it just trades opposite of the dollar. Sometimes it's a price inflation hedge. Sometimes it's a monetary inflation hedge. Sometimes it's just an expression of where real rates are. And those real rates tend to be the most consistent driver historically. So when the Fed eases policy and it takes real rates down below zero, or if real rates are falling in general, it's very bullish for gold, and the opposite is very bearish. And so by that measure, the fact that the Fed has been raising rates over the last couple of years, they took real rates from negative to positive. That should have been very negative for the price of gold, but gold held in there. And now it's kind of exploding higher. So this chart shows the price of gold on a reverse scale, just to highlight the correlation historically to the dollar. And gold has now accelerated higher, which means the yellow line is dropping, and the dollar is going higher as well. And that's very unusual. And to me, again, when the market does things that it doesn't normally do, the market could be wrong. It could all be, reverted very quickly, or there's something going on that the markets sort of know, but we don't necessarily know yet. And if we go to the next,
the markets, what is it? What is it?
So the next slide, I think, answers the question even more. So here's the price of gold, obviously breaking out in a very big way after a very long base. And in the bottom, in the orange, are real rates on a reverse scale. So in other words, going up is yields are becoming less positive, real yields are becoming less positive. And again, I do that just to highlight the correlation. And you can see that real yields went from negative to positive over the last 2 years. They've become less positive now, right? The real rate went from 3.39% to now 2.06. This is as measured by the TIPS market. And so that has been a marginally positive development for gold, but not to the point where it explains this whole new breakout. But the purple bars is the growth in a monetary base. And the fact that the money supply is growing 11%, even though the Fed is very restrictive, that's really interesting. And to me, that can be most likely explained by, again, this era of fiscal dominance, where there's so much liquidity coming from the fiscal side that it doesn't quite matter as much what the Fed is doing anymore. And so to me, this is what gold is doing. It's a manifestation of this era of fiscal dominance. And if we can go to slide 23 real quick, the dollar is moving up here as well, because the dollar is being held up by high interest rates, right? So here's the 2-year yield in purple and the dollar index in the black, and you can see it's forming potentially a pretty good base there. It's like, and I mentioned this last week, the purple line, it's like a puppet master, holding the dollar up through high rates. And so you have this
sorry to interrupt. Is there a flight to quality layered on top of that, like after this weekend, for instance?
Absolutely. And that's, just pivoting back to our early conversation. So gold, obviously, geopolitics will move gold. They will move the dollar, because at a time of crisis, and I don't want to say that this is a crisis, at least not on this side of the ocean, but at times of uncertainty, both the dollar and gold tend to do well. But the point I was making earlier is that the game plan or the thesis was already brewing, supporting both the dollar and gold, and the geopolitics only add to it. They only emphasize what is already happening. So it's not like a completely change of thesis here. It's just a reinforcement of a theme that was already in place. So you have sticky inflation, fiscal dominance, monetary policy has less impact because it's being overshadowed by fiscal. And you have now a positive stocks to bond correlation, and you now have a positive gold to dollar correlation. And so this is a whole different, whole different game plan.
There's a wonderful question here that goes back to your discussion of earnings and, where the heavy lifting is being done and earnings doing that. So how much you're in of the 10% earnings growth is simply due to the inflation margin surge, and do you expect that rate of change to slow? We get into a bit of R-star here. Where's growth? Where's the inflation story? But yeah, what do you think?
Yes, let's go to slide 12. So obviously inflation is running right now, let's say 3 to 3.5% is where the core PCE, the super core PCE, the 5-year rate of inflation, they're all kind of in that 3 to 3.5, or let's say 3 to 4 zone, but let's say 3 to 3.5. So if you think about what is a neutral policy in that environment, you can look at R star being about 1.2%. That's a real rate. And then you add inflation. So let's say add 3.5 to 1.2, you get to 4.7. All right. That's two rate cuts, from 5 3/8. So this is why kind of, 2 is the new 3 in terms of the number of rate cuts. And maybe it'll even become 1 or 0. But the other way of looking at it is if in a soft landing scenario, which clearly we're in, or a non-recession scenario, let's put it that way, a neutral policy would be a real rate of about 100 to 150 basis point. That's the historical average. And so if inflation is 3 to 4, you add 1.5 to that. Again, you get into that 4 or 5 range of a neutral policy. And that's why I think with the Fed at 5 3/8, there's some room to cut. And that's why I think the Fed continues to kind of say those things, especially Jay Powell. But there's not an urgent need to it, because what we think of as the neutral rate has been going up in part because of inflation. And then to the question of earnings, Q1 earnings season is, of course, just now getting underway. A whopping 32 companies have so far reported, so it's too early to make any drawn conclusions. But Q4 of last year, that earnings season was really good, and earnings clearly inflected higher in Q3 of last year. And so the 12-month forward estimate is now growing at about a 10% rate. Obviously, inflation is going to be part of that. If inflation is 3 to 4, then the real growth rate is more like 6, 7%. Historically, the average is 6, 7%. So it's not great, but earnings are growing. And again, to the earlier point of how we think of valuation, they're growing today. They were shrinking a year ago. And that's why a year ago, the market and we were so obsessed about when does the Fed stop raising rates? When does it start cutting? How much? Because you really need those rate cuts when you don't have earnings carrying the load. But now earnings are carrying their weight, and it makes the market much more resilient to the Fed not cutting rates as much as we thought it was going to do. And I think that's one of the reasons why the market has done maybe surprisingly well, even though it's had to walk back a number of these expected rate cuts.
It's a brilliant place to leave it on, because it just sort of gives us a sense of the strength again in particularly the US economy and how we're seeing earnings take over there. Jurrien Timmer, thank you for starting our week, giving us some clarity, after a few clouds coming over things. So it's very helpful to hear your voice of stability for all of us.
Great to see you. Thank you.